Hello everybody, it's Tom Sheridan and Ben Kumar this time instead of Chris Derbyshire, who's on the road right now. Ben, would you like to introduce yourself briefly?
Sure, I'm Ben Kumar. I've been at Seven Investment Management for 6.5 years. I have responsibility for asset allocation and for the multi-manager funds.
And for those of you who listen to LBC, you might have heard Ben's dulcet tones over the airwaves over the last couple of years. What we'd like to do is talk very quickly about what happened in 2016, some very interesting events. We'd like to talk about whether or not we have a shift from monetary policy to fiscal policy. We want to talk about whether or not that puts us much more in the hands of politicians than we would be comfortable with. Of course, we want to look at the global economy, and we want to end with the highlight, which is what are we doing about all that in the portfolios. Ben, 2016 in summary.
Well, I think two words sum it up really, Brexit and Trump. What the big surprise was that markets rallied despite those surprise events. If you'd have said at the start of 2016 that we will see a Brexit and we'll see Donald Trump, I don't think you'd have predicted double-digit returns.
You certainly would have. I mean, if you think about it, if we'd have gone back to this time last year and you'd have told me that those two things would have happened and markets would have gone up, we would have said that would have been absolutely unbelievable. How did the economy do?
Well, the global economy was just fine. If you look at the chart on the screen, you'll see that over the last 5 years, the global economy has grown at around 3.5%. 2016, no different at all. And that, I think, gives investors some heart. Once the uncertainty of politics is over, look at the fundamentals and the world's in a good place.
So we talked a little bit in the introduction about are we moving from monetary to fiscal policy? A world driven by central banks to those driven by governments. If so, that would be a major, major event. Is that what's happening?
But I think in the US, it is what we're seeing. We are stepping away from the Federal Reserve taking center stage, and we're moving towards politicians' actions driving the economy. Infrastructure spending from Donald Trump, tax cuts, all of this is good for middle America. That's good for confidence and will bring inflation back.
And outside the US?
Outside the US, I think we're still in monetary policy world. In Japan, in Europe, and in the UK, it's still the central banks you need to watch.
So what we're looking at is a divergence in policy between the US and the rest of the developed world. And that divergence in policy, if we're looking at higher interest rates, for example, in the US, spurred on by inflation in the US, that has been and may continue to be reflected in currencies, which has been a major theme in investments over the course of the last year, likely to continue to be so for the next little bit. So we know a little bit about what's gone on in the world, and there are some things that we don't know about yet. Talk to me about the unknowns.
So in terms of unknowns, we know Donald Trump is going to make America great again. We don't know what that means for the rest of the world. We know that, don't we? Well, we hope he was going to make America great again. So what that means for the rest of the world, he's likely to be protectionist in his trade policies. He thinks that America has suffered at the expense of everywhere else getting a little bit better off. We think he's going to be isolationist when it comes to military intervention, making sure the US stays out of global affairs.
Both of those would be major events. If we look at trade protection, not to be alarmist, we're not in that camp, but that is a major factor of the events of 1929, 1930. And also, isolationism brings with it its own tail risks.
Absolutely right. Donald Trump stepping back, US stepping back off the global stage, leaves room for Russia to potentially expand, China to potentially expand, and the Middle East to flare up again more than it is so already.
And Europe?
Europe's facing its own political challenges, but they're all calendar-based. We've got elections in Germany, France, Holland, and potentially even Italy. All of those promote uncertainty.
So we're talking about managing customers' money, and the conversation has been dominated by politics, which is not where we would normally like to be. Let's focus back on the real economic world for a while. What are we looking at going forward? You've already said that up until now it's been pretty slow and steady, which is fine. How about going forward?
So one of the indicators we look at is the Purchasing Managers Index. This is a survey of people who run businesses and how they feel about the future. Any indicator above 50 suggests that there's optimism, that growth is coming through. And if you look at the chart, all of the major regions are now above 50. Suggests to us that 2017 should be very much like 2016, 2015, 2014. Global growth of around 3.5%.
So if we're looking at a world of stable economics and potentially unstable politics, will need to figure out how to position your clients' money so that they can benefit from the potential upside of the former and yet protect them against the potential damage of the latter. Let's start with currencies.
So, as you said, currency is very important in portfolios in 2016, likely to be so in 2017. In 2016, we were underweight sterling going into Brexit. We benefited from that. A lot. And we now have a position much more closer to normal. So 70% of our balanced portfolio is in sterling. In the other 30%, we've moved away from the yen and into the dollar, which we think is going to get stronger.
So not an extreme currency position right now, but still a reasonable exposure to the dollar. Okay. Fixed income. We haven't really liked fixed income for quite a while now. We've been afraid of the events that actually we've been starting to see in the U.S. Talk to me about our fixed income positioning.
We've been underweight fixed income for a number of years now, and we remain so. It's the quality bonds that worry us, those most exposed to interest rate rises, which we're starting to see in the US. A small rise in interest rates can really damage the capital value of your bond. So we are very underweight, particularly US Treasuries.
So if we're very underweight fixed income has normally been the portion of the portfolio that balances out the riskier assets such as equities. And if our traditional ballast to the portfolios we don't like anymore, what is it that we're going to do about that?
Well, one thing we've been working very, very hard on is looking at alternatives. These are the kind of strategies that can offer you...
What do you mean by alternatives?
Well, it's the kind of strategies that are not correlated to either equities or fixed income.
Right.
Now, they take a lot of work to dig into, and we're prepared to do that work. We're building up an allocation over time to replace what fixed income used to offer.
So this is a unique aspect of 7IM's portfolio construction right now. And it in and of itself is a very long discussion. And we would encourage you to contact your 7IM advisor to get chapter and verse on what we're doing about the alternative assets which are taking the place of fixed income to an extent in the 7IM portfolios, a very, very key theme for us. Now, equities, overall, we're about a normal position, but the composition of the equity exposure has changed.
Yeah, there's been a big shift for us. We've been overweight Asia for some time, and that worked very well for us in 2016. However, with the arrival of Donald Trump on the scene, we don't know much about how well his policies will be implemented outside of the Twitter sphere. But what we do know is that he is prepared to take a swing at China, at Korea, at Taiwan, because he thinks they're stealing American jobs. So we've moved from overweight Asia to underweight Asia, and we've deployed that cash into Europe and into America.
Now, Europe underperformed last year, didn't they?
Yeah, rose only about 1%, whereas the rest of the developed world rose double digits. We think that's because the political risk, all those elections we talked about, had been overpriced by the market. People were avoiding Europe. Now, that looks like an attractive opportunity for us.
And in the U.S., is there a particular part of the U.S. that we want exposure to?
Well, we're focusing very much on the small company sector of the U.S. because that's where Donald Trump's policies have the most impact. Tax cuts are really, really helpful for small companies, as is the confidence boost to the consumer.
So the small companies pay the taxes because they don't have the ability that the multinationals have of moving money around the globe and not necessarily paying all of their U.S. tax. Is that it?
Exactly right. Multinationals are going to come under fire from Donald Trump because what do? They move jobs abroad. That's not a popular thing to be doing right now, and we've seen him take aim already at a few of these large companies.
Ben, thank you very, very much. So just to recap, we find ourselves in a position right now of looking at a globally economically stable world, a potentially disruptive political landscape. We have featured currency management very strongly over the last year. We'll probably continue to keep a very close eye on what's going on in the currency markets. Fixed income, as we said, we don't love it anymore, and we've been doing a lot of work on the alternative section of the portfolios, and we've changed our regional allocations on equities, but we're still broadly neutral on the equity component. I'd like to thank you very much again for all of your support through all of 16, which was a good year for 7IM and your customers, and we look forward to 2017 as the story unfolds. Thank you.